Everyone tells you real estate returns 8% a year. Nobody tells you about the roof, not the hypothetical roof, the actual roof that needs replacing on a 30-year-old rental property in 2026. With labor costs up and material costs up, and a contractor who is booked out 6 weeks and does not particularly care about your timeline, the average roof replacement in the United States right now, $9,000 to $18,000 for a typical home. More for larger properties or complex geometry. That is one bill, one unexpected bill, on one Tuesday. That is your entire year of 8% returns on a $200,000 property, gone, before the property management fee, before the property tax, before the vacancy month when you are finding a new tenant. And here is what makes this interesting. Bitcoin has hidden costs too, different ones, quieter ones, but real ones. Today I want to put every hidden cost on the table, for both assets, no filter, no cherry picking, the full picture. Because most people who invest in either of these things are operating with an incomplete spreadsheet. My name is Donald Cash, double chin, gold tie, a dog named Jerome who is currently staring at a corner of the room for reasons that nobody in this house understands. I own both real estate exposure through REITs and a 5% Bitcoin position. I have made expensive mistakes with money. I share everything. Today, the hidden costs, both sides, complete. Let me start with real estate, because the hidden costs here are more numerous and more varied, and I want to be specific, not general, specific. I am going to walk you through the full cost of owning a $350,000 rental property in 2026. A realistic mid-market property, 1 unit, single family. Most people look at this property and see rent minus mortgage equals profit, maybe $800 a month. Nice passive income. Let me show you what they are not seeing. Cost 1, property tax. The national average effective property tax rate in the United States is approximately 1.1% of assessed value per year. On a $350,000 property, $3,850 per year, $321 per month. This number is not optional. It does not go away when the property is vacant. It does not go away if you have a bad month. It does not go away in a recession. And in some states, it is much higher. New Jersey, effective rate around 2.2%. Illinois, around 2.3%. Texas, around 1.7%. In New Jersey, on this property, approximately $7,700 per year, $641 per month, just in property tax. Cost 2, insurance. Landlord insurance on a $350,000 investment property, approximately $2,000 to $2,500 per year. Average, around $2,200, $183 per month. Note, this is landlord insurance, not homeowner insurance. Landlord policies are more expensive because they cover liability for tenant injuries, loss of rental income during covered repairs, and building damage. If you have homeowner coverage on an investment property, you may not be covered at all. Cost 3, baseline maintenance. Industry standard, budget 1 to 2% of property value annually for ongoing maintenance and repairs. At 1%, $3,500 per year, $292 per month. This covers the routine stuff. HVAC filter changes, gutter cleaning, minor plumbing, appliance repairs, pest control, small fixes that add up. But the 1% does not cover the big stuff. The 1% is just to keep the property functional between major replacements. Now, I want to pause and talk about the big stuff, because this is where the hidden cost calculation gets genuinely important. Major capital expenditures, the costs that do not show up in a monthly operating model, the ones that arrive infrequently but expensively. Roof replacement. A standard roof lasts approximately 20 to 30 years, so over a 30-year hold, you replace it at least once, possibly twice. In 2026, the average roof replacement for a residential property, $9,000 to $18,000 for standard asphalt shingles. The national average sits around $9,500 to $11,000 based on NerdWallet and industry data. For larger homes or complex roof lines, $14,500 to $22,000 or more. Average it out, call it $13,000, one time every 25 years. Amortized over 25 years, $520 per year, $43 per month. That sounds fine, until the roof actually needs replacing and the $13,000 arrives as a single bill in October. And here is the thing, if you are using a property management company, they call you about the roof, not the amortized monthly cost. They call you and say the roof needs replacing. The estimate is $15,000 $200. When can you authorize? That is the real experience. HVAC system. A central HVAC system lasts approximately 15 to 20 years. Replacement in 2026, approximately $6,000 to $12,000 for a standard residential system. Average around $8,000 to $9,000, amortized over 17 years, approximately $500 per year, $42 per month. Again, fine as an amortization. Less fine as a single emergency in August when the system fails during a heat wave and your tenant calls at 11 at night and you are trying to find an HVAC contractor who is not booked for 2 weeks. Water heater. Lifespan, 8 to 12 years. Replacement in 2026, approximately $1,900 to $9,000 depending on type. Standard tank heater, around 1,500 to 3,000 installed. Let us call it 2,200 average. Every 10 years. Amortized, $220 per year, $18 per month. Appliances. Refrigerator, dishwasher, washer, dryer if included, each with an 8 to 15 year lifespan, each requiring replacement eventually. Budget approximately $200 to $400 per year for appliance amortization. Foundation, plumbing, electrical. These are the wildcards. Foundation issues, $3,000 to $100,000 plus, depending on severity. Plumbing, anywhere from a few hundred for a simple fix to $15,000 or more for repiping. Electrical panel upgrades required by code, $2,000 to $8,000. These do not fit neatly into an amortization model. They are tail risks, low probability, high impact. Budget a tail risk reserve of approximately $500 per year for the things you cannot predict. Let me add all of this up for our $350,000 property. Monthly operating costs. Property tax, $321. Insurance, $183. Baseline maintenance, $292. Property management at 8% of rent. Assuming rent of $2,000, that is $160. Vacancy allowance at 5%, $100. Total monthly operating costs before mortgage, $1,056. Monthly capital expenditure reserves. Roof amortization, $43. HVAC amortization, $42. Water heater, $18. Appliances, $25. Tail risk reserve, $42. Total monthly capex reserve, $170. Total monthly true cost to operate the property before the mortgage, $1,226. Monthly rent, $2,000. Monthly cash available for mortgage service, $774. A 30-year mortgage on $262,500 at 6.5%. A realistic 2026 rate is approximately $1,660 per month. Monthly cash flow, negative $886. Wait, that is significant. At current mortgage rates, a property with 25% down and realistic operating costs is cash flow negative by approximately $886 per month. This is the reality of buying a rental property in 2026. Unlike 2015, when mortgage rates were around 3.5% to 4%, today's rates of 6 to 7% fundamentally change the cash flow math. The same property, the same rent, the same expenses. A 3% difference in interest rate creates the difference between modestly positive cash flow and meaningfully negative cash flow. This does not mean rental properties do not work in 2026. It means the returns are almost entirely in appreciation and equity paydown, not in monthly cash flow, at least at entry. The 8% annual return figure cited for real estate includes appreciation. The cash flow component in 2026 for a newly purchased property at current mortgage rates is often negative before appreciation. If you are buying real estate for passive monthly income in 2026, the math requires either a much larger down payment, a much lower purchase price relative to rent, or waiting for rates to decline. Now, Bitcoin's hidden costs. I know what you are thinking. Bitcoin does not have a roof. Bitcoin does not call you at 11 at night about the HVAC. This is true. But Bitcoin does have hidden costs, and I want to walk through all of them honestly. Hidden cost 1. Exchange and transaction fees. Every time you buy Bitcoin through an exchange or brokerage, you pay a fee. On Coinbase, approximately 0.6% for standard transactions. Through a Bitcoin ETF like BlackRock's IBIT, the expense ratio is currently 0.25% per year on the total value of your position. On a $50,000 Bitcoin position, $125 per year in ETF fees. Not a major cost. But if you are trading frequently, buying and selling based on price movements, the transaction costs accumulate rapidly. Someone who traded Bitcoin 15 times in a year at 0.6% per transaction has spent 9% of their position in fees on a $50,000 holding. The hidden cost here, trading frequency. The more you react to price movements, the more you pay. Hidden cost 2. Capital gains taxes on every sale. This one is large and systematically underestimated. In the United States, every time you sell Bitcoin at a profit, you owe capital gains tax. Short-term gains held less than 1 year are taxed at ordinary income rates, which can be 32 to 37% for moderate earners. Long-term gains held more than 1 year are taxed at 15 to 20% federally, plus state taxes. Here is what most people do not realize. Every time you spend Bitcoin, pay with Bitcoin, or exchange one cryptocurrency for another, that is a taxable event. The IRS treats every use of Bitcoin as a sale at the current market price. So, if you bought Bitcoin at $10,000 and spend it when it is worth $50,000 to pay for something, you owe capital gains tax on the $40,000 gain, even if you did not convert to cash. This creates a tax drag that is entirely invisible until tax season. The practical implication for most investors: if you hold Bitcoin through a conventional ETF in a tax-advantaged account, a Roth IRA, for example, this cost disappears. The gains grow tax-free. But most casual Bitcoin holders are not doing this. Hidden cost 3. The opportunity cost of volatility. This one is psychological and financial simultaneously. Between November 2021 and November 2022, Bitcoin fell 77%. Someone with 50,000 in Bitcoin watched it become approximately 11,500. During that same period, if they had been invested in a diversified dividend ETF, they might have seen a 10 to 15% drawdown, not 77. The difference, approximately $35,000 to $40,000 in relative value, not a real cash loss if they held, but a real opportunity cost compared to what a less volatile asset would have returned. The hidden cost of Bitcoin's volatility is not just emotional. It is the compounding that did not happen on money that was sitting at a 77% loss for 12 months. Hidden cost 4. Custody risk. If you hold Bitcoin directly in a self-custody wallet, the hidden cost is the risk of permanent loss. Hardware wallet fails. Seed phrase lost. House burns down with the backup. Researchers estimate that 3 to 4 million Bitcoin are permanently lost. Gone forever, including early miners who lost their wallets, including people who threw away hard drives in 2011, not knowing what they contained. This is a real cost, a probabilistic one, but real. The mitigation is holding through a regulated ETF, which transfers custody risk to a professional institution, IBIT, FBTC. This largely eliminates custody risk in exchange for the ETF expense ratio, a trade most investors should accept. Hidden cost 5, regulatory risk. Bitcoin ETFs exist in the United States because the SEC approved them in January 2024. That approval can theoretically be modified. Tax treatment can change. Government policy can shift. This is a tail risk. Not a likely near-term scenario, but a real cost in the risk model. Real estate has regulatory risk to rent control changes, zoning changes, short-term rental restrictions. But the regulatory framework around residential real estate is significantly more stable than the cryptocurrency regulatory environment. Let me put both hidden cost profiles side by side. Real estate, property tax, insurance, maintenance, capital expenditures, property management, vacancy, transaction costs on sale, capital gains with depreciation recapture. Total hidden cost on a $350,000 property in 2026, approximately $12,000 to $16,000 per year in true operating costs beyond mortgage service. Plus tail risks. Bitcoin through a regulated ETF, expense ratio of approximately 0.25%, capital gains tax on sale, transaction fees if actively traded, custody risk largely eliminated. Regulatory risk, real but tail probability. Total annual holding cost for a $50,000 Bitcoin ETF position, approximately $125 in fees, plus tax obligations on any realized gains. On a pure ongoing cost basis, Bitcoin is dramatically cheaper to hold than rental property. On a complexity and ongoing attention basis, Bitcoin is dramatically simpler. On a cash flow basis, Bitcoin generates none. Real estate generates negative cash flow at current rates in year one of most acquisitions. On a volatility-adjusted return basis, This is where the comparison becomes genuinely interesting, and where the individual investor has to make a real decision. So, what should you actually do with this information? Here is my honest take. If you are considering buying a rental property in 2026, the cash flow math does not work the way it worked in 2015. The combination of elevated home prices and elevated mortgage rates means that most single-family rentals in most markets will be cash flow negative for the first several years. The return thesis is primarily appreciation plus equity paydown, not monthly income. That is not a reason not to buy. Appreciation and equity paydown are real returns, but be honest with yourself about what you are buying. You are buying an appreciating asset with leverage, not a cash flow machine. Not yet. If you are considering Bitcoin in 2026, the hidden costs are lower than most people expect, but the volatility is real and the psychological cost of watching large paper losses is genuinely significant. Position sizing is everything. If you want real estate income without the roof, the HVAC, the tenant, and the negative cash flow year one, REITs are worth understanding. VNQ, SCHH, SCHD has REIT exposure. Quarterly distributions, no property management fees, no tax basis complications at sale. For most people who are not professional real estate operators, REITs plus a modest Bitcoin allocation is a more practical implementation of the real estate and Bitcoin thesis than either direct property ownership or a large undiversified Bitcoin position. Jerome has stopped staring at the corner. He has transitioned to staring at a different corner. I have no explanation for this behavior. Neither does Jerome, apparently. My tie is still tight. And the portfolio is still working. Let the money do the work. In the comments, have you ever been surprised by a hidden cost on a property you owned, or a hidden cost on a crypto investment you did not see coming? Real stories, real numbers, if you want to share them. I reply to every comment. Donald Cash, out.